Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. I've been doing this over 3 years now. I've been in this style of investing since about 2018, something like that. And one thing I have to say that I keep seeing once in a while is that this kind of investing, income investing or investing that's more geared towards covered call products, covered call ETFs is bad for young investors. Young investors who have a lot more time in the market should stay away from it. It's not worth it because the total returns would be better. With index funds, this style is really only best for retirees and later, right? To transition later to get cash flow when you have a big amount of money, et cetera, et cetera. You know, however you want to phrase or say that kind of statement. So in this video, I want to really ask the question that people have been asking me, and I've asked myself several times as well, and even discussed it with my wife recently. So I said, might as well make a video now on this since it's fresh in my mind. Would I choose, or would we have chosen PII if we were young again? If we, this was 5-10 years ago, when we were starting to invest seriously. Is income investing, is this style of investing bad for young investors? Should they just ignore it and just go with growth and index funds and pay attention to it later? Let's attack that in this video right now. All right, everyone. So would I choose PII if I was young again, if it was 5-6 years ago? Of course I would, everyone. Of course I would. I mean, come on. I love this style of investing. But I know what you're thinking, right? You would have had so much higher, better returns probably if you would have just went with the index funds. Well, you could be right. Well, probably are right. But I still, regardless, even with those higher returns, would have done PII. And let me go through 7 reasons why. Let me back it up. And then I'll actually use some real life test cases, including myself, of why I think this investing style could be for everybody, not just people that are retirees. It could be a good way to invest for young people as well. So let's get to it. So reason number 1 is that you're building yourself another income stream. This is very powerful. You're building yourself cash flow that could be useful right now, right? So in case you have whatever age you are, whether you're working, you're not working yet, cash flow, consistent cash flow could always be useful, whether it's to pay off some expenses, your phone bill, your gas bill, an emergency, your car breaks down, you lose your job. Cash flow is very, very useful, and it could be very useful now. So it could be a big advantage investing this way compared to, let's say, index funds that barely have any cash flow. And I know what you might be saying, well, listen, if you need cash, you could always sell and draw down. Yeah, but what if the market is down at that time? You got to sell at a loss. What if you just don't want to sell and you don't want that on your mind, right? So I've spoken to a lot of people who just don't like that strategy of drawing down, of selling their units, because then there's cases of, well, how much do I sell? If I need something and the market is down, I got to sell at a loss. When do I get back in? So these are things you could avoid. Reason number 2 is this style of investing really does give you, in my opinion, discipline, motivation, and knowledge. So what do I mean by that? Well, when you have the knowledge of how to make money, more money with your existing money, it's extremely valuable knowledge to have when you're young, right? This could give you motivation because you're seeing the more you invest, the more passive income you make. So it gives you motivation. It gives you discipline as well, because instead of, you're always going to have it in the back of your head, and I still have it now. Yeah, I could maybe buy a new car or go or buy something fancy. But if I invested instead, I'll make an extra $10, $15, $50 a month pretty much forever. So it gives you great discipline as a young investor. And I'll talk about a few case studies later, real life examples, but that definitely reason number 2. So unlike the growth style, where let's say you just put your money in the index funds, if you're investing at, let's say when the market is high and it goes down, you could get discouraged, right? I actually know a young girl, from the gym in Montreal who just went with the index funds. She started in 2021, and when the market started going down and down and down and then down, because there's not much cash flow, she got discouraged and really, kind of gave up. So this is something that could happen as a young person. Obviously, I know you should keep buying and investing and dollar cost averaging, of course, but I'm just saying that the PII style does give you a little bit more of that discipline and motivation to keep going. Number three, this is a very nice advantage that income investing has. It gives you a lot more flexibility versus growth investing. Growth investing, you don't have any flexibility. You dependent on the market. Market goes up, you got to sell to make a profit, to make money. With the income style, you get money every month. You get your primary source of return is the income, and you could do whatever you want with the income. Reinvest all of it, reinvest a portion of it, reinvest half of it, spend all of it because you have an expense that month or you need it. You have more flexibility. Growth style, limited flexibility. Point number four is there's less stress. You're less stressed because you are not dependent on stock prices and what the market does. With growth investing, you are 100%, okay, maybe not 100% because some of the index funds has a little income. You're 95% dependent on what stock prices do and what the stock market does. You got to buy low to sell high later. That's the only way to make a profit. So you're very dependent on the stock market. Income investing, not the case, because if you're generating that income with covered calls, which is infinite income, pretty much you're not dependent as much on the stock prices. Of course, there could be some exceptions, like the split funds, right? Where if they go down to a certain point, they're not going to be paying. But excluding those really specialty funds there, I'm talking, if we just stick with, let's say, covered call ETFs. And yes, even covered call ETFs, the income could fluctuate a little bit, but it's relatively consistent. You're not as dependent on stock prices. It's a defensive way of investing with a lot more, less dependency on what's going on, which is really one of the things I love, because this is why I declare all the time I don't care about stock prices, because I'm not dependent on stock prices. I'm dependent on the monthly cash flow only, right? Next point is it's really easy to invest in this style now compared to even a couple of years ago, 3, 4, 5 years ago when I started. We have a lot of, especially in Canada, even in the US, amazing leverage, lightly leveraged, covered call options now where you could, you don't need the split funds anymore. You have a lot of great options. You have sector specific ETFs, you have broad ETF, you even have index based covered call ETFs that are leveraged where you could get easily 12, 13, 14% yield. You got non-leveraged. You're not comfortable with the leverage. You have the same thing with the non-leverage, right? Evolve has the S&P 500 with covered calls, the TSX 60 with covered calls. Horizons has the same thing with leverage, without leverage. Now they even have EQCL, which is basically an income leverage version of XEQT or VEQT, right? So there's a lot of amazing options. It's extremely easy to get that 10, 11, 12% consistent without the risk of missing, like with the split funds. So a lot of great options, much easier now than even in 2018. It's been absolutely incredible. All these great products that have all come out and of course are reviewed on this channel in the last couple of years. Next thing to remember, also something a lot of people don't think about, especially if you're a newer investor, you're younger, is that the last 10 years, I'm talking about like after 2008, after the crash of 2008, all the way to COVID, that's over 10 years, approximately 10 years, has been a crazy, insane bull run. And we've been spoiled with almost 0% interest rates. This is not the normal. A lot of people, especially now, are learning that lesson when interest rates are back at 5. They think it's so high. Interest rates at 4 or 5 is really normal. It's not that high. So when interest rates get cut, this fuels speculation. It fuels money going into the riskier assets, because why go in fixed income and bonds and GICs that give nothing when interest rates are really, really low, if anything non-existent. Those instruments are not very popular. Now they're getting more popular and picking up steam because interest rates are going up. So what I'm trying to say is that the last 10 years of that stock market, whether you're looking at the TSX 60, the S&P 500, or even more insane, the NASDAQ, all you see is this in the last 10 years. Maybe that's not going to continue for the next 10 years. Now, I would say I'm always a pessimistic guy, but I'm optimistic that over time that the stock market will go up. But maybe in the next 10 years, they're not going to be like this. Maybe they'll be a little bit slower. So this will mean that the income strategies, covered call ETFs, will perform much better. That's when they perform best, when the market is a little bit more calm and flat, right? So that's another reason to think about. The next 10 years might not be like the last 10 years. And I would say the most important point, the most important advantage, this is, for me and a lot of other people I speak to, is that I think PII, income investing, is the quickest way to financial independence, which for me, my opinion here, is the ultimate total return, right? So a lot of people are obsessed with total returns, and that's fine. It is a very important part of investing, but it's not everything. Your life, your quality of life is the most important part, if you ask me, right? So in my opinion, forget the 4% rule that could take, you need $1 million plus $2 million. With PII, you could achieve financial freedom as quickly as possible. And I'm not saying you need to achieve it so you could retire at 35, at 40 like we did, but it's to get your financial freedom so you could start your life 2.0, your non-slave life. And just because you hit financial freedom, financial independence, doesn't mean you need to quit your great career, your job. But going to work because you want to is much different than going to work when you have to, right? So this helps a lot of people. It definitely helped me to take the steps to, start a YouTube channel and explore different options, start your own business. There's a lot of people, entrepreneurship is picking up steam. It's a lot easier. You can work online now. It opens the doors, it opens the options. So I think that, financial independence is by far the most important total return that this style of investing could give. And the argument, again, of, yeah, but Adrian, if you would have invested in the indexes, your total return would have been better, etc. Yeah, but I wouldn't have been financially independent, which wouldn't have made me been able for my wife to quit her job and then my job and discover moving to Panama, where I wouldn't trade that in a million years for any amount of total return, right? The quality of life will always trump numbers, right? Numbers, total return. That's just me. So, I'm a perfect test case where even when you're young, it could be so much valuable. It could even be more valuable, in my opinion, than a little bit more total return. So those are really what, the 7 points. Now, there's a couple of test cases I could also share with you. These are real test cases of people that I have either spoken to online, but, even met in person in Montreal at the Blossom event a few months ago. So I have 3. Let me share them with you. Test case number 1 is a young man who's in nursing school, and he basically told us that in between semesters, he works really, really hard. I don't know what job he has, but I'm assuming it's maybe a restaurant job or something like that. He does overtime. He works really, really hard during his time off, right, in between semesters, summer break, I guess. And he invests it all in PII because he says that cash flow, that cash flow that investing in PII gives him, helps him to support his expenses, pay his expenses while he's in school. And that means he doesn't have to work when he's in school. So he has much better focus on his studying and, passing his exams. He doesn't have to worry about going to work after school and things like that. So this is a test case that I found very interesting. So he's very young. He's like in his early 20s, and he's using this style of investing to enhance his quality of life, to focus on his studies. This is a test case number 1, right? Because that cash flow is going to cover a lot of his expenses. Even if he's making $200, $300, $400, $500 a month, that is helping him not to work during the semester, freeing up his time to study and get ahead in school. So that's test case number 1. Real test case. Met a guy in Montreal, really, really nice kid. Test case number 2. These 2 young guys, also that I met at Blossom event in Montreal, they basically told us that they just finished school, started the career. One is an engineer, one is actually went to work for BMO. I don't know what, but let's assume pretty good salaries, right? Pretty good careers ahead of them in the next 5-10 years. And they're still living with their parents. And they said that their number 1 goal, thanks to the channel, looking at the channel and see it's possible, learning about, these types of investments, is to become financially independent. And after their calculations about how much money they need to save and invest, they're easily going to do it before 40 years old. 35 is their goal. By 35, 40, these guys are going to be for sure financially independent. I actually think they have, especially if they get promotions and things like that, like we went through, you'll make more money, it'll be quicker and easier. So that's another test case. Again, priority on the financial freedom, the financial independence versus just total return, which I'm not saying is a bad thing, but priority should be quality of life and financial independence over total return, in my opinion. Test case number 3, a good friend of ours who started investing. She has 2 young daughters in their early 20s, also in school, about to finish up school. And I helped them invest in their TFSA. And at the beginning, I actually told them, look, you're young. You should put some in the indexes as well. So what they did is they decided to do a mix of, things like HYLD and the covered call leveraged ETF stuff, and also an S&P 500 index ETF. I'm pretty sure it was VFV. And after a few months of experiencing the investments, they decided to get rid of VFV and just go with the income-oriented funds because they love the income. So these girls are in their early 20s. They're both making about $300 to $400 a month in their TFSAs, which is tax-free. They just love getting that cash every month. They could use it. They could reinvest it. I think most of them, they're mostly reinvesting it, but they have the flexibility in case they got to buy some new books for school. They like the flexibility. They like seeing the cash coming in. So I don't see how investing in PII could be bad for young people. Now they know, and this goes back to one of my points, the knowledge and motivation and discipline. They always know what to do with their money now to make more money. This gives them motivation. It gives them discipline because instead of buying stupid crap they don't need, going out and blowing their whatever money they made on their side jobs or their current part-time jobs while they're in school, they could invest it and make a little bit more, a little bit more, a little bit more. That's where the snowball starts going. You start getting motivated. So that's another test case, which is real life. So it's giving them confidence. So in summary, everyone, life isn't just about total returns, right? It's about, your life, right? Your quality of life. There's a reason why I've been saying this message for the last 3 years, enhance your quality of life and become financially independent. For me, that's the number one mission or goal of why I became an income investor. There's many advantages in income investing, this style of investing, that cannot be measured by numbers, cannot be measured mathematically, right? But I think investing is not just about the numbers. I'm not saying ignore the numbers, but if your mission is just total return, that's completely fine. I think I have nothing against growth investing or like investing in indexes or dividend investing. I say it all the time. I like these investing styles. I think they all work well long term. It really depends on your situation, your priorities in life, right? So this is why I don't like when people randomly say this style of investing is bad for young people, right? That it's not worth it for them, et cetera, et cetera. It's only for older investors. It's people who have a lot of money and that are retired and just need the cash flow. But who exactly are you to say that and judge? It's completely it's a personal situation. It's a personal mindset. Investing is 100% subjective. So this is why I would highly disagree with people who say that it's not black and white. So please be open-minded, not closed-minded. The best investors in the world are always open-minded. Life is much better when you have an open mind. Trust me. And again, I'll repeat something I always say. I like growth investing. I like dividend investing. I think they all work long term. There is no best. It's about finding the best for you. So hopefully this was useful for you. Let me know what you think in the comment section below. Even the haters, you're more than welcome to comment. And I'll see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.